Today was just going to be a recap of last week. So here's the S&P. And one thing you'll notice is that last week, really not much happened. Bitcoin is continuing its trend higher. Disney, interestingly, is starting to gain some. Came off the low back there in November at 80, and it looks like it's heading towards 100 now. So Disney looks like it's starting to pick back up. Hello, folks. Dan Bird here on a Sunday right after Thanksgiving. So today's November 26th. And I'm sitting in for Mike Zuber, who is still on his river cruise. I think he probably is somewhere on the Rhine by now, heading towards Amsterdam. Hopefully he'll be back soon. So look forward to catching up with him when he gets back. But I'm flying solo today. I'm going to do two videos today. One's just going to be a recap of last week and some concerns that I'm seeing short term. And then the second one is a request from somebody from Wednesday's video that asked me about Tesla. So I'm going to spend a little bit of time looking at Tesla and the rest of the Magnificent Seven as well in the second video. So let's get started. Let me share my screen first. Let's see. Okay. So here's the website. If you're interested in getting the free newsletter, which comes out every Saturday, just go to breakpointtrading.net and click on this button right here. If you want to register, you can register your email so that you'll get alerted each week when it comes out or when it's ready. But it's not necessary. If you just want to come to the website each time and click on this button here, you can go into the newsletter. I'm going to actually use some of this in this part of the video. So let's first look at the S&P and see what happened there. I'll talk about some of the concerns that I have. So here's the S&P. And one thing you'll notice is that last week for 3 days, so this would be Friday was a half a day, and then Wednesday and Tuesday, really not much happened. It did go up, interestingly, but not by much, and it didn't, there wasn't much of a range, but it did gain a little bit. However, look at the momentum indicators. The RSI relative strength is right at the top. This is when it sometimes will start to roll over, although it can stay overbought for a while, like it did back in here. But you can see when it gets over 70, a lot of times it will pull back. So that's what I'm kind of expecting to happen here soon. The PPO or MACD is also starting to roll over. So there's a gap down here that probably will fill at some point, and it might be in the short term. So I'm kind of expecting, you can see the volume, very low volume last week, which is typical of Thanksgiving week. There's not many traders out there. Now, when they come back on Monday, this might continue to go higher, might actually break out of this resistance level because all the traders will be back on Wall Street and there'll be a lot more volume next week. But at the same time, they could very well take profits. So this is the time of year, the next couple of weeks, when mutual funds and a lot of big traders and even individuals will take profits in their gains for the year or take losses so they can have losses to write off before the end of the year. That usually happens in the first couple of weeks of December. And historically, the first couple of weeks of December usually sees a pullback. So we might see that again. I'll show you some things about that in a second. The NASDAQ looks similar, although it actually looks, the PPO is actually even closer to crossing over. So, and it's also hitting its resistance level right there. On Thursday, it hit resistance and actually pulled back a little bit. So the NASDAQ actually pulled back somewhat, but I'm kind of expecting the same thing here. There's a gap down here as well. So it may pull back. It might fill that gap. Filling it would bring it back to the 21-day moving average, which is reversion to the mean typically. So that's very normal. It actually would be healthy if that happened. So we'll see. I'll talk about this again when I get to in the second video with the Magnificent Seven, because they're kind of setting up the same way. So NASDAQ looks similar. We'll look at Bitcoin real quick. Bitcoin is continuing its trend higher, although slowly. It's moving back and forth, sort of a little bit sideways, a little bit higher, continuing to kind of try to move higher. And the US dollar, which is right in the middle, continuing its trend lower. So the US dollar continues to head lower. Gold is going up a little bit. 20-year bonds are increasing. 10-year yields are decreasing, although they had a little bit of a rally on Friday, back to 4.5%. But I would not be surprised to see the 10-year yield get down, even down to 4%. Way down here that's where support is. So I wouldn't be surprised if it continues lower, gets down to around 4%. We'll see. So let's look at next. Let's look at what happened in the markets last week. So here's the Dow. You can see the Dow, the S&P. Let me see if I can make this bigger. There we go. So the Dow and the S&P both gained slightly on Friday. NASDAQ lost a little bit. The small cap and mid cap actually did fairly well. Small caps actually had the best gain of all the indexes. So that's starting to fill out the breadth, which we really want, because small caps and mid caps have been lagging the rest of the market, and they might be starting to catch up right now. Look at the VIX, though. I'll talk about the VIX in a second. That is unbelievably low. So when the VIX gets that low, what that means is we probably won't have big, huge gaps higher. And we also won't have huge declines. So if we do get a pullback, it will probably be a short one, or, but maybe back to that 21-day moving average. The Dow, these are the main ones on the Dow, biggest movers on the Dow. J&J at the top. Disney, interestingly, is starting to gain some. Came off the low back there in November at 80, and it looks like it's heading towards 100 now. So Disney looks like it's starting to pick back up. Walmart's number 3, even though they had bad earnings. You can see the big drop when the earnings came out. Intel is actually surprising. So Intel actually has been a big mover. Let's look at the NASDAQ. NASDAQ right here. iRobot was the number 1. Look at that, big gap up. I think that was earnings on Friday. Most of the rest of these are not ones that I recognize too much. If we look at the small cap, iRobot's there again, and also 3D Systems had a really nice move on Friday. Both of these came up on my screens on Friday. So there are ones that you might want to take a look at. iRobot had a 38% gain. So might be a good one to wait for a pullback, although it could just keep going higher. But 3D Systems looks very interesting right here. That's a 3D printer. Now let's take a look down here. Let's look at the industry groups and the sectors. So sectors, again, there's more breadth, but some of the defensive sectors are up near the top. So you can see consumer staples is number 5, healthcare is number 1, and healthcare seems to be starting to move as well. Healthcare usually likes the fourth quarter. That's when a lot of healthcare plans go into their end of year, and people sign up for their new healthcare plans for the next year. Energy is starting to pick up a little bit, making a little bit of a comeback, but not much. Here's healthcare. Healthcare looks pretty interesting, getting up near a resistance level. Real estate is up near the top. That's another defensive sector. Financials usually likes the fourth quarter, but technology and communication services and consumer discretionary, these are the 3 aggressive sectors. They all on Friday were at the underperforming end, at the very bottom of the list. So we'll see what that means as we go into next week. Again, it's kind of reinforcing my thoughts that the market's due for a pullback. You can even see in the best industries on Friday, we've got utilities, energy, financials, consumer staples, real estate. Those are the best industry groups, with reinsurance being you know, it's been doing really well lately. Pharmaceuticals and healthcare is doing great. But interesting, let's look at the worst performing, and renewable energy just cannot get a break. Renewable energy just keeps declining. It looked like it was ready for a rally, a little rally, and did have a little bit of a rally. Went from 250 to 300, but renewable energy just has not looked good at all year. Internet index, which is where Google is, also Meta. Those are two on the Magnificent Seven that we'll look at. It's also pulled back, although it's had a really nice run. Computer hardware, where Apple is located, also had a really nice run and is pulling back some. This is just reinforcing my theory. It's semiconductors is also one of the bottom groups down here. So semiconductors also had a really nice run, starting to have a little bit of a pullback. So I think that is a trend that might continue into the first or even the second week of December before we get a big rally at the end of the year. So for that, let me go to the newsletter, because I want to point out a couple of things in the newsletter. And again, if anybody is interested in getting this each week, just click on this button. It comes here to this PDF, and you open that, and you've got the newsletter right here. IBD has market confirmed uptrend last week. As Mike said, existing home sales, he said it might be worse than 3.9, and it was 3.79. But pretty quiet week overall. Thanksgiving, the market was closed. Next week, the big one that I'm looking at is PCE. Also, GDP is next week. So 4.9, this is still Q3 GDP. Q4 GDP is expected to come in at about 2.1. But this is a recap of Q3 at 4.9. But PCE and core PCE is the one that the Fed will be looking at. And this one at 3.7 for last month, it doesn't have a forecast yet, but I'm expecting this one to go down. Now we need to watch this, and I'll talk about it more as we get closer to the next CPI number in December. But I think we might get a flat CPI in December and actually a worse CPI in January. And we'll see what happens. The next CPI number in December is literally the day before the next Fed rate meeting. So if it's flat, I don't think they'll raise. But if January is worse, a worse CPI, there's a potential that they could actually raise a quarter point in January. So we'll see. We'll keep an eye on that as we get closer. The ones for real estate, of course, is building permits. Next week, new home sales, 730, a little bit lower, practically flat. And then initial jobless claims and pending home sales next week at 1.1%. We do not have a jobs number, even though it's the first of the month. The jobs number will come in the next week on the 8th. And that will be really interesting too, because it'll come in the week before the Fed meeting and the next CPI. So that's going to have a critical factor as well. So let me show you, this is what from Stock Traders Almanac, what December typically looks like. You can see inflation report is on the 12th, Fed rate hike is on the 13th, options expiration on the 15th. We've got Christmas right there. But look what happens at the beginning of December. It kind of goes sideways and even maybe down into the middle of December. But then right after options expiration, and actually this third week of December, is when it really starts to take off. And right about here, I put on here the Santa Claus rally, and we're going to start tracking that once it starts. In this case, it starts on the 22nd. Santa Claus rally, a lot of people think that it starts before Christmas, but it actually technically, and this is something that was created by Stock Traders Almanac, it was actually created looking at the last 5 days of the year, and then the first 2 days of the new year. So that's what we'll be tracking when that starts. This is what it looked like last year. So I tracked this last year. If all three of these criteria are positive, then historically the next year ends higher. So the Santa Claus rally, last 5 days plus the first 2 days, you can see it was kind of flat down here, but it started to move up. So it was actually up 0.8%. Not much, but it was positive. The first 5 trading days is the next criteria. Last year, in the first 5 days of 23 was up 1.4%. And then the third criteria for this January barometer is the full month of January. And the full month was up 6.18%. So you can see all 3 of these came in positive. The year ended right around 3,800. That's on the S&P. And I'm pretty confident that we will be higher than 3,800 by the time the year ends, the end of December. So we'll keep a watch on that as we move forward. Talked about those already. The other thing to look at is the VIX. So here's what the VIX looks like. And actually what I'm going to do is I'm going to go into the website, go to the charts section, and on the charts section down here is the VIX chart. You can actually see what the VIX looks like. If the VIX is above 20, bears are usually in control. If it's below 17, bulls are in control. Right now, it is at 12.46. That's where it closed. And these are the lows, the previous lows going back the last few months where this blue line is. And it actually closed below that blue line. So the VIX is extremely, extremely low right now. And one of the things that I said in the newsletter, see if I can find it here. Very positive. In fact, the last time it was this low was almost exactly 4 years ago, November of 2019. And it stayed low until the end of January as the market steadily climbed higher. During that time frame, the market rose almost 7%. So keep that in mind, that end of January, the last time the VIX was this low, because I think the market is going to continue to rally into January. And then I really want to see that CPI number in the middle of January, because if it comes in higher than expected, inflation higher than expected, then that could be the point where the market starts to really sell off. So last time it rose 7%, the last time the VIX was at that point, of course, that also was the period just before the COVID crash. So we have to be careful of that. All right, so back to the VIX. There's what it looks like right now. The put-call ratio is still elevated. That's actually a good thing because it means that traders are betting that there's going to be a big sell-off. So usually when it gets above 0.75 and especially 0.80, that's usually when the bottoms are put in. You can see here 0.85, the bottom was put in right there. And then we're still at 0.75 right here. So we're getting close to, overbought territory. So I wouldn't be surprised to see a sell-off in the first couple of weeks of December. All right, so let's go back and take a look here at let's take a look at the Keltner channels. This shows you extreme overbought levels, and you can see right here the S&P is definitely extremely overbought. It won't stay that overbought for very long. It normally will pull back to the mean. The mean in this case would close that gap, bring it down to 44.25. So that's 125 points roughly that it could potentially fall. So that's something that we have to be aware of, be careful of, because that's something that could happen the next couple of weeks. If we look at the Keltner channels for the NASDAQ, it's also very overbought. It's in the 3x level. I actually got into the 4x level up here. So this one again could come back and close this gap right down here. So we'll have to watch out for it. Those are some of the concerns that I have with the market. Now, one of the things that's positive for the market is VectorVest. Here's the VectorVest chart. I put this in the newsletter as well. VectorVest just gave a confirmed up signal right here, Friday. So to get a confirmed up, a number of things needs to happen. It needs to be moving up. The number one is the BSR, the buy-sell ratio, has to be above 1. And you can see right here how much that moved. So the week before it was at 0.95. It moved all the way to 1.1 in 1 week, and really in 3.5 days. Actually, in 1 day. It moved that much in 1 day. So this was the day before Thanksgiving, and this was on Friday. That's a huge move for the buy-sell ratio. It's basically just that takes the number of buys divided by the number of sells, and you get a ratio. VectorVest tracks 9,100 stocks. Now, that includes ETFs as well as leveraged ETFs. So 9,000 is a lot. It's not all just companies. So, but the important thing is that BSR level right there. It finally got up there and gave a confirmed up signal. Now you can see back here, confirmed up is the most conservative, takes the longest to trigger, and usually can last a little while. In this case, the last one lasted for a month. The one before that lasted for about a month. So there's a little bit of chop in this area right here. The one before that, this is back in January, that lasted for a month as well before we got a confirmed down. So that is really good news because these usually will last a little while. But even better is what I like is the DEW, which is an early warning signal. It's kind of the canary in the coal mine. So you can see this one triggered back on November 3rd. So this has actually been positive for a while now. The market is just continuing to climb higher. So that's all very positive as well. We just have to get through the next couple of weeks as far as, I think, as far as the next maybe a small pullback that we're going to get the next couple of weeks. So keep an eye out on that. We'll look at the growth versus value ratios. This is something I also put in the newsletter, but I've heard people talk about the 50-day crossing the 200, the death cross, and this is what I point out right here. Ever since the beginning of 2023, these are growth stocks versus value stocks. It's basically the Russell 1000 growth versus the Russell 1000 value. And it is a relative comparison, meaning the first parameter, which is growth, if the line is rising, is outperforming the second parameter, which is value. So if this chart is rising, that means growth is outperforming value. That means Wall Street is rotating out of value and into growth. The exact opposite that happened back here in 2021 when the market was hitting all-time highs. It was the last all-time high for the market. Growth versus value was declining. So Wall Street was rotating out of growth and into value as the market was hitting all-time highs. That was the signal that the market was ready to go into a bear market. That's not what's happening right now. You can see not only the Russell growth versus value, but also large cap right here, mid cap is also climbing, and even small cap has regained its highs. It hasn't broken out yet, but it's heading in the right direction. So all of these growth versus value indicators are showing that Wall Street is expecting this rally to continue. And I think once we get through the next couple of weeks of maybe a pullback, I think it's going to continue probably into January, sometime in January. So all of those can be found. This is the Magnificent Seven. I'm going to talk about these in the next video. So we'll take a look at that at that point. So that's where we are right now. Just real quickly, let's take a look at renewable energy because that was the worst performing industry on Friday. You can see here it's really had a really tough time the second half of 2023, continuing to go lower. And if we go back here and take a look at the sector charts, we'll actually look at, I wanted the sector charts. We'll look at which stocks in that group are underperforming. So here's renewable energy right here at the bottom. And if I click on that, it brings up the top performing stocks. EVgo, #1 performing stock. Fuel cell, interestingly, is doing well. Just it's coming off a bottom. So I don't know if that's going to go very far. And here's Enphase. Enphase just barely had a plus day. And Plug Power also right near its bottom. If we look at the worst performing, you've got First Solar right there as one of the worst performing stocks, Jinko Solar. So the solar stocks, here shows technologies. The solar stocks are really having a hard time lately. Look at that. So all of these solar stocks are really, really doing poorly. Here's Solar Edge, also near the bottom of the list, just continuing to go down. So even though these were the darlings after COVID or during COVID, they've had a really tough time, and renewable energy in general has had a really rough time lately. If you're thinking about getting into any of those stocks, you need to look at the industry and watch the industry, and it really needs to start breaking out back above these moving averages before I think it would be safe to get back into some of those. Unless you really want to risk it, thinking that it's as far down to the bottom as it can possibly go, which may be the case. But that's what it looks like. All right, so that's it for today. Let's see if there's anything else in the newsletter that's interesting. Talked about all of this. These dividend stocks, by the way, VectorVest has talked about these dividend stocks that was in U.S. News article, 15 best dividend stocks. In VectorVest, you can put them in a portfolio. I actually did that for those stocks. The result was negative 10.5% for those dividend stocks. So you can't just go by clickbait or news articles. Look at what's actually happening with those stocks. In fact, on my site, I have a portfolio section, and I have the ones that I did last year, dividend candidates for last year. I'll actually show you this in VectorVest because it's up to date. Here's the portfolios right here. So dividend scans, here's Dividend Aristocrats, negative 0.31%. Here's the VectorVest blue chip scan. These should be the best blue chip dividend paying stocks. Remember, this started in January 3rd of last year, up 1.28%. And then I created my own scan using some very stringent parameters starting January 3rd, and mine is up 26.5% since January 3rd. And these are all the stocks you can see best performing are energy stocks, naturally. I will do this again for the new year, and I will do all three of these and post the stocks that come up, whatever comes up in these scans. The big thing for my scan is I look for only companies that have an earnings yield that is at least double the dividend yield. So their earnings have to be performing twice as good as their dividend for it to make this list on my scan, which you can see 26.5 is pretty good. And by the way, this is only equity gains. This does not include any of the dividends that were paid out through the year. So anyway, thought that was interesting. We'll look at that again at the end of the year, or when I create my new list. I'll put it in the newsletter, in fact. So that's it for now. Thanks for listening. Hope you tune in to the next one where we'll go through Tesla in particular and some of those other Magnificent Seven. Thanks for tuning in. Have a great weekend, and we'll talk to you soon.